Folks, you better get ready because in today's video, we are going to be breaking down the top 4 best stocks to buy for big growth heading into the coming months and throughout 2024. Each of the stocks in this video not only has big momentum, but also has an underlying business that is accelerating at a rapid clip. We'll go through specific details, where it makes sense to buy, the risks with each, and what you should know. And then at the end, we're going to discuss how we managed to call out massive winners like BMR, MGIH, and HOLO over the last week, and how you can spot the next ones too. And the only thing I ask in return is that you hit that ravishing like button and don't forget to subscribe. And as always, make sure to do your own due diligence on all stocks presented here on the channel. If you're the one taking the risk, you got to be the one doing the ultimate risk, my friends. Okay, number 1, Mara lovely Mara. So Mara is arguably the top crypto mining player today and certainly the best Bitcoin miner. And Bitcoin miners are key right now because let's face it, Bitcoin is breaking out huge. She hit 50K for the first time since November 2021, and if history is any indication, she'll make a new all-time high this year, which means finding companies that have a ton of Bitcoin on their balance sheet, are able to produce Bitcoin at a rapid clip, are well managed, and have good cost management, well, that can be a killer strategy for growth. It's something that you gotta be paying attention to. And Mara is a key example of one stock that is primed to really benefit from this Bitcoin acceleration. Mara has 15,741 BTC on her balance sheet. Every time Bitcoin goes up 1%, these holdings get that much more valuable. At the same time, and even more importantly, Mara is shooting out more and more Bitcoin every single day. Mara just reported a 58% boost in Bitcoin production year over year when comparing January 2024 to January 2023. And quite frankly, January 2024 had a lot of hiccups and they could have done a much better job, but still 58% boost. Now, context for people who are new here, Mara was a top pick in our previous top stock videos, and she's continued to perform exactly as we have long expected. This is the second cycle we've nailed Mara on in the last couple of months. We called her out in the first run starting back in December, heading into the Bitcoin ETF approval, and then we called her out again after the post-Bitcoin ETF dip cycle. Now, the crux of the argument, the bullish case for her, is that she tracks Bitcoin as a Bitcoin miner and rakes in dough off Bitcoin during Bitcoin bull cycles when demand is really going up, and Bitcoin historically goes up huge into and after Bitcoin halving. With Bitcoin halving happening in April, that goes to say that Mara should continue to have substantially more upside potential, and every dip that you see is likely going to be bought up based on that thesis. And folks, never ever doubt how contagious momentum can be. Once Mara breaks out last cycle's highs at $31.97, I believe you're going to see another massive leg up, and Mara is likely going to shoot easily to 40 or even 45. Mara is not just a sound and relevant fundamental play right now, but she's also a huge short squeeze candidate. According to Ortex data, Mara has short interest at 21% of free float. 21% is a ton. Remember, shorting is borrowing shares that are already out there and reselling them again on the market, which means that not only is all this short interest suppressing the price of Mara by quite a lot by creating artificial supply of shares, but it also means that if the price keeps going up, these shorts are going to be buried more and more in losses, and many will be squeezed out. So that's another factor that one can't miss here. So where does it make sense to buy Mara lovely Mara? Well, originally we said it makes sense to buy her at any price under $20, that $20 resistance and new support level. But if you're too late on that, I'd argue the second best time to buy is buying the actual momentum itself before it breaks out to new cycle highs at $31.97, because after that, you're going to be moonshotting, in my opinion, and I think that it's going to be too difficult to have a risk managed position at that point. Okay, risk factor time. It's risk factor o'clock. What is the risk with Mara stock? Well, Mara is a dirty little tease. She teases, she squeezes, she teases, she squeezes. She has a long history of huge uptrends that end up getting dumped on and consolidated on fast and then bought up again. So if you're someone who buys blindly, especially someone that waits to buy at all-time highs, well, you're going to get screwed. You need to understand what you're buying. You have to look at the history. You have to understand how to have risk management, and you got to go in with a trading plan. Also, in terms of a business model risk, if the Bitcoin thesis proves wrong or we enter a new crypto winter, well, Mara's business model will go into hibernation once again, and we'll have to wait for her next emergence. So, different risk factors to consider. Every stock has pros and cons. It's up to you to weigh in to see if it makes sense for you to play. Number 2, ARM, ARM. So ARM is one of the few clear and major AI benefactors today, and one of the newest that's getting recognition. In my opinion, ARM is a killer deal at any price under $100. In the $100, it's okay, but I'd watch for a bigger pullback. Context first, well, ARM is a British semiconductor and software design company with a hot business model. ARM makes money primarily by licensing its chip designs and architecture to semiconductor companies and collecting royalty fees on the sale of chips based on its technology. This business model allows ARM to benefit from the wide wide adoption of its technology across various sectors, including mobile devices, automotive, and increasingly in areas like the Internet of Things, IoT, and artificial intelligence. This licensing and royalty model provides ARM with a scalable and profitable revenue stream without the need for manufacturing. But Charlie, who uses ARM chips? Well, Apple uses ARM architecture for their processors found in iPhones and iPads, and for the M-series chips used in MacBooks and other Mac computers. Amazon Web Services uses ARM architecture, Microsoft uses it, NVIDIA itself uses ARM architecture for certain processors and gaming consoles. And their latest earnings completely destroyed analyst expectations as well as even management's guidance. Now, yes, ARM makes a ton of money on royalties, but people are excited about her because she has a ton more room to raise royalty rates once they get their customers on lock, which means moolah coming in. From analyst Dylan Patel of Semi-Analysis and the Financial Times, this is what he said. Patel says ARM has a huge amount of room to increase the royalty rates it charges device makers that use its chip designs. He notes ARM already charges phone makers something on the order of 50 cents a phone for its mobile CPU designs. Qualcomm's royalties for using its radio chips, for example, in a high-end phone might run something like $13. So that's the deal. Every time you're buying a phone, every time you're buying anything with an ARM chip in it, well, guess what? ARM is getting a nice royalty on it, and it doesn't have to do much other than design the chips. So ARM is uniquely positioned to service the massively booming demand for companies needing higher performance chips, and it's locking in those customers and really raking in the dough. But you might be confused. How do ARM and NVDA, for example, differ? Well, remember, ARM's business model focuses on designing chip architectures and licensing those designs to manufacturers, who then pay ARM royalties on each chip sold. NVIDIA, on the other hand, designs and sells its own branded chips and graphics processing units, GPUs, directly competing in markets like gaming, data centers, and AI. While ARM earns through licensing and royalties without manufacturing, NVIDIA generates revenue through the production and sale of its hardware and related software solutions. Of course, there are pros and cons with each, but if you're a smaller company trying to emerge as a leader, well, it's much easier to do ARM's business model, and that is why so many people are rushing to buy the stock. So back to the chart, ARM is just starting to get big attention and gain relevance for its work, but as of the time of shooting this video, it's on a deep dive from recent highs, which I believe is going to be a momentary breath. I do believe that holders in this might very well be obliterated over the next few sessions, maybe at worst a few weeks, but then you'll see a bottom and then a huge pickup as it goes to new all-time highs. Many people see ARM as the most direct competitor to NVDA. I don't think that's the right way to look at it because, again, they have different business models, but certainly they are serving the same segment of the market. But if you were to compare the two, ARM is a baby compared to NVDA, and the valuation of ARM, even if you squared them apples to apples based on revenue, is still minuscule compared to NVDA, which means that if you were to compare the two, ARM is very much undervalued. Okay, now it's risk factor time. So ARM has risks to it. Of course, ARM operates in a highly competitive semiconductor industry where rapid innovation is critical. It's the name of the game. Just because it's been killing that game so far doesn't mean it will continue to do so, and if it gets behind, then its royalty business could be destroyed, which of course will hurt its stock. But, and this is what I would say, given its current dominance and track record, I'd argue its pastures continue to look very green. We'll continue to follow it to make sure that's the case, but that is one risk factor to be aware of. Number 3, PLTR. So in my opinion, this is the year that Palantir stock will show the world what Palantir the business has been doing all this time. Its underdog status is getting totally obliterated and will be obliterated by the end of the year. Palantir Technologies is revolutionizing how companies interact with data. With cutting-edge AI and machine learning capabilities, Palantir is completely dominating the big data analytics market, making it an irresistible pick for those looking to capitalize on this next-gen digital age. Its client list includes top-tier government agencies and tons of Fortune 500 companies, underscoring real proof of concept for Palantir's unmatched value and continued growth in the marketplace. The buzz around Palantir's role in solving complex global challenges from pandemic response to securing national defense further amplifies its allure as a stock that's not just an investment, but a stake in the future, and I believe that Palantir is going to be one of the biggest companies in the world one day, maybe within the next 10 to 20 years. But at the same time, here in today's current age in 2024, well, Palantir stock follows what I would call a realization curve. Palantir's business, the business itself, isn't really very volatile. It's been on a steady and consistent uptrend for years with few very minor hiccups here and there. Yet, it's only when earnings literally scream profit and uptrend that people start realizing and waking up to smell the oranges. How else can you explain these massive pumps all of a sudden in the last year? There's lots of other small cap stocks that haven't benefited from the return of the bull market, yet Palantir has had one of the biggest returns. People closed their eyes to Palantir for years, and now they are once again being forced to wake up and smell the roses. The same folks that you couldn't beg to buy Palantir in the sub $10 region are now emptying their accounts to buy it at $20, $25. But the truth is that it's not too late for Palantir. The stock still has substantial more upside. We made the case for Palantir to get to $51 by the beginning of 2025, which is still potential for a double, and that's if Palantir only meets this year's guidance. I believe it's pretty clear they're going to exceed it, and I believe markets will expand multiples further for Palantir once they show more proof of concept in coming earnings reports, because that's been the case historically as well. Okay, risk factor time. So Palantir's valuation and continued increase represents a pure belief that Palantir will continue scaling, but every time they have any kind of hiccup, their stock tends to be overly decimated. They could have 10 amazing quarters in a row, and then one quarter where it's a little bit more of a sleeper, and then everyone's like, okay, this is going to bankruptcy, sell now. So my suggestion here is that if you're someone trying to blindly buy and hold Palantir without understanding what you're buying, without having risk management, and so on and so forth, I would say don't do that, and instead avoid Palantir like the plague. Maybe you should buy something else like, I don't know, the Teletubbies, because the Teletubbies, at least they're pretty damn consistent. They just kind of dance around and they have pretty little colors, and it's a nice time, you know. I support the Teletubbies. Sometimes they're a little creepy though, but you know, it is what it is. Okay, number 4. So NVDA is indeed a cash machine, and as we've said for months, it is still not time to ignore this stock yet, especially before its earnings come out on February 21st, which is just about a week away. Yes, be aware that it will have a big dip cycle eventually, but that just means you need to have a tight stop loss. That doesn't mean you need to be scared of it. It means it's time to ride momentum, and then when the momentum dies, you can have that stop loss get stopped out, and then you're good, you're golden. And then the next dip cycle, you could ride the next wave. NVIDIA's strategic positioning in high growth sectors such as its traditional gaming sector, data centers, automotive, and most importantly, AI computing underpins its long-term growth potential. While there's many companies that will make tons of money off chips and AI high computing, it's really difficult to surpass NVDA as a market leader because it's got an extremely extensive patent portfolio, its strong ecosystem of developers and supply chain, which results in a very, very strong manufacturing capacity and great cohesion between sectors of NVIDIA's company. But of course, it's also just got that brand recognition, which is hard to beat. Moreover, NVIDIA's financial health, marked by strong revenue growth and solid profit margins, supports continued allocation from big money managers. NVDA is going to be a leader in AI for the foreseeable future, and while it may eventually be dethroned, that time's not coming anytime soon. Even though NVDA has climbed substantially and has been one of the most insane growth stories in history, well, money managers today continue to tell their clients that they need to be allocating more into the stock, saying it's a compelling buy for folks who are investing in the future of computing and AI and the next digital age. And one of the biggest mistakes that you can make right now is ignoring what I like to call contagious momentum. For example, this morning, Bloomberg headlined this article: NVIDIA's $560 billion rally has analysts racing to boost targets. UBS, Mizuho follow, Morgan Stanley, BofA, Goldman Sachs in hiking targets. Now, contagious momentum, folks, is when stocks go up and analysts and funds rush to upgrade them further, causing more to buy in and then causing more analysts and funds to rush and upgrade them further. And that's what's been happening with NVDA for a while and why it is still in huge momentum. Now, in terms of the chart and looking at the stock price and wondering if it's going to come back down to earth, well, what I will say is that NVDA has been going up since early January without really any major room to breathe. It's going to get a big breath and people are going to say the bubble has popped, but what will actually happen is it'll blow out some of the FOMOers that bought at all-time highs, but then it'll get bought up by the rest of the market because NVDA continues to be the clearest winner of this massive technological age that we're entering into. Best way to play: ride momentum with a tight stop loss or buy the next dip. Okay, but what about the risk factor, Charlito? Well, in my mind, the biggest risk factor to NVDA stock is a return of a more hawkish Fed. Markets are pouring into NVDA right now because there's a lot of capital preparing for the next rotation in the next 6 months to a year or two into companies with high revenue and high earnings growth, and NVDA is one of the clearest winners in that. But if the Fed becomes more hawkish, those multiples start crunching and capital gets driven out in mass, and that drives capital back out of markets and back out of NVDA, which could be a disaster for the stock. Another risk is a Chinese invasion of Taiwan. Of course, Taiwan is a global hub for semiconductor manufacturing, and their key suppliers are over on that island, so an invasion could lead to a substantial disruption in NVDA's supply chain, affecting its ability to produce and deliver products on time, and of course, a massive problem for the overall economy. Okay, next, so if you didn't know, every single day we have what we call a morning morning briefing for ZipTrader U members. This is done over Discord, and members get a list of the top stocks with hot setups or catalysts dropping every single market open morning. Usually these are fast-moving, fast-acting catalysts with high potential. So let me show you some recent examples of huge winners. We'll start with BMR. So BMR we briefed on yesterday at 9:05 a.m. Eastern at roughly $5.25 a share, and it proceeded to run to $34.94 a share. That's about a 566% increase briefing price to highs. Why did we brief on it? Well, they announced a team up with NVDA, a super small cap company partnered with one of the biggest and most applauded companies in this cycle. Was destined to create a huge run, right? And that's exactly what happened. Another example was MGIH, which was another one from yesterday. We briefed on her at roughly $2.18 a share. It proceeded to sell off into open, but then went on to run to $9.57 at highs, a run of about 338%. Another example, last week on the 7th, we briefed on Holo, HOLO. That was at about $2.08 a share. It was a float squeeze on steroids. It then proceeded to run to $51, which made it our top play so far this year. A pretty insane run, if I have to say so myself. Now, at the same time, let's talk about some that didn't work, because when you're trading catalysts, when you're following catalysts, when things are dropping, news items are dropping, sometimes they react the way you want them to, sometimes they don't, and that's why risk management and being aware of the upside and downside risks are so important. So yesterday we briefed on Wish at roughly $6.34 a share, and it ran a bit more into open to $6.99 and then dumped. Big dumpy dumbito, and in this situation, we were simply too late on the catalyst. I thought there was more room to run. There wasn't. Another one was last week on the 7th. We briefed on HKIT at $3.22 a share. It proceeded to run to $7.75, but it fizzled out so fast at market open that this was one of the most painful fake outs I've seen. Sure, you could have played the original upswing, but liquidity was low and prices moved too fast. So the point is, folks, while we can't promise you big runners all the time, we can promise you that we'll get you informed when catalysts and hot setups emerge, and we'll make sure that you're on the front page when we find a new trending setup. If that sounds interesting to you, I'll put the link to join ZipTrader U down below. We got a nice coupon code there for Valentine's Day, and that's going to be on for a few days, so make sure to take advantage of that. Anyways, folks, that caps off today's video. Have a great rest of your day, and we'll see you in the next one.